A very good morning to all of you who have joined us this morning for our webinar on the investment scene, an analysis on the present and the outlook for the future. Well, we're all going through truly unprecedented times. The world is fighting the COVID-19 pandemic, and it is definitely affecting not just our health, but also the economic conditions that we are in. Globally, the stock markets have also reacted. We have seen its worst bout of volatility, and uh, well, the US 10-year bond yields have crashed to the lowest in history. Um, we've seen crude seeing its largest single day crash, and in India too. The Sensex and Nifty were at record highs in the beginning of the year, and now they have seen a sharp decline. Well, what does all this mean to all of us as investors? I'm sure most of you are worried as to where we are heading. Well, to address these concerns, today we have with us Mr. Gaurang Shah, Geojit's head investment strategist, and he will help you understand the economic impact of COVID-19, how it is going to impact our investments, what we should do in such situations. Well, Mr. Shah has over 25 years of experience in the equity markets. He shares his expert views on both the domestic and global markets on national and international television. He also monitors the changes in government policies and how it is going to impact the various sectors. He tracks gold and other commodity markets as well. So over to Mr. Gaurang Shah to take the session forward.
Yeah, morning everyone. Thank you for connecting into this webinar, and I would also like to extend my thanks to Jyoti and the entire team at our Geojit head office who has put this webinar together. As Jyoti was mentioning, these are some unprecedented times, and we have gone through a very difficult situation, a situation which we have not seen or witnessed before. And these kind of unprecedented situation calls for unprecedented steps and moves and policy changes. And as we all know that the financial market across the world has gone through a lot of difficult times, starting with the Great Depression or the geopolitical situation in the Middle East or the financial meltdown of 2008, as we all know this as the Lehman Brothers crisis. And more than that, we have also seen on the domestic front our own, Harshad Mehta and Ketan Parekh related scams. Along with that, in 2014-15, we saw the crude shock of oil in form of oil prices going up beyond expected levels. All this led to difficult times into the world financial market, including our own market. But we have managed to overcome that. And now we have got a situation in form of this COVID-19, which has left the entire world in a state of shock. And this is why, because there are one too many questions and very few respectable answers to this question as we speak. The situation cannot be gauged in terms of the outcome because of the uncertainty that we all of us are facing. But let me say this, that at least in India, in terms of the percentage of people getting affected of this COVID-19, with respect to the recovery of run rate, I was watching this morning, we are close to 30% in terms of recovery run rate. And of course, the number of people who have lost their life. When you compare this to the rest of the world, I think we are at a lower end trajectory, assuming that the situation does not get out of control and that we are able to maintain the discipline that we have displayed over the last 40 plus days. There are certain concerns with respect to certain states. That is, of course, we have Maharashtra, Mumbai topping the list, followed by Gujarat. We had concerns in Madhya Pradesh, We had concerns in Rajasthan, Delhi, and of course in Tamil Nadu. Rest of the India, there has been a little bit of positivity. So my feeling is that if the situation does not get out of control, and if the lockdown period does get extended in certain states, as has been mentioned by certain chief ministers, including yesterday, we had a brief press session from our chief minister, Mr. Uddhav Thackeray, where he kind of indirectly indicated that there might be some extension of lockdown, possibly till end of this month. No clarity, but of course, there was an indication over there. Now, if the situation does not get uglier, then at least on the Indian equity market, the lows that we saw in the recent times was on 23rd of March, where we saw Sensex making a low of 25,981, and on the Nifty spot, we saw a low of 7,610. So our view, assuming that the situation remains where it is and there is a likely possibility of improvement, our view is that the revisit of these lows that we saw on 23rd of March or a breach of those lows, at least in the current scenario, given the present conditions, does not look that it will break again or it will make another low. Of course, this is subjective to the numbers and the improvement run rate as we go forward from here on. The other trigger that could change the fortune of the world economy, world equity market, including our economy and our equity market, is the larger trigger in form of the magical drug stroke insulin, which the world over there is a race to find a cure or a solution of this COVID-19. Now, we must also not forget that from the lows of 23rd of March till yesterday, if you actually go to see, we have come a long way. I think we have recovered almost about 20-25% or thereabouts, plus or minus 2-3%. And this recovery that we have seen, what we have kind of come to a conclusion is that the range for the markets in the near term for Indian equity markets, especially on the Nifty, if I have to extrapolate in terms of the levels, then 8,800 to 9,000 is the lower end of the range. And we have seen that over the last maybe about 15-20 days, the markets Nifty has gone to these levels and then bounced back to maybe 9,300, 9,500, or the high that we very recently saw of 9,800 on the Nifty spot. So our view is in the short to medium term, the range is going to be 8,800 to 9,000 on the lower side, 9,300, 9,500, and if things start getting improved, then we could possibly go to maybe 9,800 and even 10,000. This is of course subject to a great deal of improvement, especially in those states where the numbers have gone pretty high over the last 5 to 10 days. So what are those triggers which could possibly help sentiments to get improved? Now, I have listed down a few of them. So first, I would like to highlight what are those positive triggers. So the first of one that we saw was from the Honorable RBI Governor, Mr. Das. He came and he addressed not once but twice since the time this epidemic has broken out. And he has also mentioned that RBI will be at war footing as far as the necessary steps that needs to be taken to provide this system with liquidity. And some of the measures that the Reserve Bank of India has undertaken was in form of open market operation, OMO as we call it, and LTROs. And he also went to the extent to say that these are not the last steps. As and when the need arises, the Reserve Bank of India will take appropriate steps to make sure that there is enough liquidity in the market and that liquidity translates into the system which is required all the more. The second one is the long expected fiscal stimulus from the government of India. Now, over here, we have seen that this lockdown got extended 3 times, possibly that maybe come 17th of May, we will have certain states extending the lockdown, certain states where the situation is getting better, there could be some more relaxation, but we need to monitor this very, very well. So the reason what I understand is that since the lockdown got extended, the government also extended the time of announcement of this fiscal stimulus, possibly to take into consideration what is going to be the eventual impact of the shutdown on the economy, which are those sectors which are very, very vulnerable, which are those sectors that need absolute immediate dose or a boost that is needed to fire up and come back to normalcy. So that is why we expected this delay. And I am of an opinion that come next week, as the date nears, there should be some amount of clarity as to what is the form of this fiscal stimulus by the government of India. The third positive that I have come across is the prediction of monsoon. And let me tell you this, friends, for India as a subcontinent, monsoon is very, very important given the fact that larger part of our population is dependent on agri activity. And the first prediction that came out from SkyMet was that this monsoon this year is going to be 100% of long-term averages. By this month end or possibly by next fortnight, 2 weeks, we'll have one more prediction coming out from various authorities. And I'm quite sure that this time also, for maybe the third or the fourth consecutive year, we are going to see favorable monsoon as far as Indian subcontinent is concerned. And if that happens, then large part of the concern in terms of food supply chain, production of agri products, food grains, vegetables, etc., would be taken care of. The fourth and the most important trigger that my colleague Jyoti also referred to in her opening remarks was the correction or a crash in crude oil prices. Now, for India, it is very important because more than 70% of our energy requirement in form of petrol, diesel, LPG, kerosene, we import in form of crude oil. And each and every barrel that we import of crude oil, we have to pay in dollar terms. And to buy dollars, we have to spend rupees. So it was good to see the correction in crude oil as far as India is concerned. But more than expected correction also is not good for those economies who produce crude oil, as that is the main source of revenue for those countries. I'm talking about OPEC and OPEC plus countries, which are largely dependent on production of oil and export of oil. So if crude oil prices in the international market remains lower than the cost of production of crude oil, then of course that leads to economical unviability for those countries which are largely dependent. So there also we have to see stability come through. So on one hand, we have a lower crude oil prices. On the other hand, we also have to see the stability in terms of Indian rupee INR versus the US dollar. Now, until the recent time, we saw that the new normal for rupee on the strength was 68 and the weakness was 72. Then, of course, this unfortunate event happened in form of this epidemic COVID-19, and we saw rupee cross over 77 against the dollar. And as we speak, we are somewhere close to about 76 to a dollar. Now, if these two situations, lower crude oil prices and a favorable range in the rupee against the dollar remains, then I think we don't have to worry, because one thing we have to remember, lower crude oil prices benefits us, but a weaker rupee offsets those benefits in terms of lower crude oil prices. And of course, like I mentioned, the other point that the total number of population infected in terms of percentage is much lower compared to the other countries. And I hope that we stay like this and the number of new patients come down and the recovery run rate goes up. And it has been steadily going up, as I referred to, close to 30% this morning in terms of recovery of the total infected people. Fatalities, of course, is also there, but it is not as large as we have seen in some of the other countries. Given this situation, if the things remain favorable, then revisit of that close of 23rd March, at least in the present scenario, does not look possible. If situation deteriorates, there is no doubt that we will revisit that and even breach it. So it's only a matter of time. Patience, we'll have to wait and watch as to what the situation arises. For the financial sector, the benefit was announced by the Reserve Bank of India in form of moratorium. 3 months have been given. There is presentation made to extend it by another 3 months. That means from 90 days to 180 days, from 3 months to 6 months. And I guess we'll have more clarity over there. India's contribution to this epidemic in form of that magical drug. We are talking about homeopathy. We have heard a lot of news. We are talking about Ayurveda. This morning there was a news that there is Ayush. There is going to be Ayurveda, test that is will conducted to find out whether there could be break possible in form of an Ayurvedic medicine to treat this COVID-19. So that result will be awaited. In form of earnings, friends, well, we are seeing the numbers for the fourth quarter last financial year, and whatever numbers we have seen up until now, there is, I would say like this, there has been no major disappointment. Of course, there are a lot of numbers yet to be seen for the last financial quarter of last fourth financial quarter of last financial year. And I hope that that is not get much uglier, because the impact of COVID-19 was felt possibly in the third and the fourth week of March. So fourth quarter's numbers will not have as much of negative impact. But this financial year, first quarter and second quarter could see some more pain, especially on those sectors which are extremely vulnerable to the current situation. Some sectors will show relatively less stress, but sectors which are totally dependent and will have the worst negative impact in terms of stress levels would be the sectors which are absolutely vulnerable to this COVID-19. Domestic data up till now is not something that we have to worry about. I'm talking about the IIP and GDP. But because of the lockdown situation across the world and of course in our country, this data could be a concern in the near to mid-term, because it will look very, very depressing. And even the collection of GST is going to be much, much lower because there is no economic activity. So we have to brace ourselves as far as the domestic data points are concerned with respect to IIP, GDP, collection of GST, and more importantly, inflation. Now on inflation front, as we all know, we have been in a comfortable zone. But when you have a situation like a lockdown, where you have economic activity coming to a standstill, where you have no movement of goods and services, naturally under such circumstances, there is the possibility that inflation will tend to rise in the immediate short to medium term. How we are going to face the situation, that again, as we go to that time, as we come to the bridge to cross that river, we will only come to know. So let's hope that we are able to maintain the discipline and there is not going to be any worst negative impact as far as inflation, GDP and IIP numbers are concerned. And of course, on the interest rates front, right from the beginning of this year and last year, Reserve Bank of India has been on the path of lowering interest rates. But just lower interest rates do not really help economy. I think that has to be translated in terms of transformation of lower interest rates from Reserve Bank of India to the banks, from banks to the consumers, corporates, individuals, etc., etc. So that transmission has to happen, and that will happen over a period of time. What we have to brace ourselves is concerns now. If I can elaborate on the concerns, conflict between US and China with respect to the outbreak of COVID-19 virus, and its impact on the world order. Now, if this spat between US and China gets uglier, and as the President of the United States of America has mentioned not once but a couple of times that he's going to levy more sanctions, there has been war of words between the two countries with respective dignitaries. Unfortunate situation, but let us hope that this does not get out of control and this does not lead to any kind of larger conflict, which the world has to pay a price. So we'll have to brace for this particular situation. We have to also brace ourselves in terms of the new world order, life post COVID-19. Like we are interactive right now. Had it been a normal situation, I would be visiting all over India, conducting IIPs like I have come and met most of you all across India and even with our joint venture partners in the Middle East. Unfortunately, because of this lockdown, the new world order is that we are doing a webinar. So these kind of new terminologies, new situations we'll have to adapt to and possibly see how soon we can find a break in terms of a treatment, an insulin or a drug or an injection, whatever. I referred to crude oil prices, and this I also mentioned that it is good to see lower crude oil prices as far as India is concerned. But as far as those economies or those countries where they produce crude oil, and crude oil is a larger contributor to the revenue of the government, respectable government, it is not feasible to have lower crude oil prices in the commodity market when the cost of production is going to be relatively higher. This will lead to, if the situation gets ugly, I'm just assuming this, I'm not saying that this will become an eventuality, but one has to keep eyes open. If crude oil prices in the commodity market remain lower than the cost of production of certain OPEC nation or OPEC plus nations, then those countries which are oil producing nations and where the cost of production is much higher, those economies will go through a financial distress because their economy, their budget will go out of the window. And if this happens, then I would like to call this a C2C crisis, which is crude oil to currency crisis. I hope that there is no big correction in crude oil prices, and even if it is, we will only see it temporarily, and again crude oil prices will go. The new normal, according to us, I think anywhere between $20 to $30 could be the new normal for NYMEX. Between $30 to $40 or maybe lower could be the new normal for Brent. I'm talking about US dollar per barrel. This could be the broad range, subject to, of course, no geopolitical situation, no destruction of global pipelines, or no dumping from those larger nations which have got lower crude oil price of production, start dumping into the world commodity market, subject to all this. Now we come to the view as far as the government of India and RBI is concerned. Long awaited fiscal stimulus, long awaited financial measures from the Reserve Bank of India. And we are of the opinion, friends, that whatever measures will be taken by the government of India or the RBI will not be the last or the final measures as and when the situation arises, because let us face it, friends, these are unexpected situations which we have never seen before. And to assume or anticipate that the outcome could be this or that is also very, very difficult. So we have to take steps as and when the time approaches, when situation starts unfolding. And I'm very sure that the government at the center, government at various state levels, and the authority in terms of Reserve Bank of India will take all necessary steps, will change policies and start implementing them at ground level as and when these kind of situation and circumstances arises. I don't know when that normalcy will come. I don't know when that stability will come, but I pray to Lord that it comes sooner rather than later, not only in India, but in the world order. And once this stability or normalcy starts returning, our sense is that the government will also be in a fast track mode as far as the divestment process is concerned, because that is one avenue which will generate revenue for the government. Of course, in terms of financial stimulus also, everyone has their own opinion, and I'm also a little bit concerned with respect to how much of stimulus will come, who will get that stimulus, which will be those sectors which will be given priority, which will be those sectors which will be given less priority. Of course, we'll see it only when it comes. So as and when the situation starts stabilizing, getting normal, I think the process of divestment will also start coming through sooner rather than later. Inflation, like I mentioned, has remained low, maybe because of the lockdown, no economic activity, supply chain issues, etc. The inflation, as far as food related inflation is concerned, vegetable related, dairy products, etc., will start looking a little bit ugly because the supply chain has got its own hurdle. So at least in the short to medium term, maybe inflation could be inching up, but because of steps taken by the state government, central government, there could be some amount of ease going through. Fund flows, as far as FIs are concerned, well, no doubt, since the beginning of this epidemic, as far as India was concerned and it got affected, we have seen net outflows as far as FIs, that is foreign financial institutions, are concerned. But on the flip side, if you actually go to see the data, flows have been stable and increasing, though at a very slow rate, but slow and steady increase has been coming. And what data AMFI has given out in terms of month on month, I think what I am given to understand, I stand to be corrected if I'm wrong, that the equity related flows have been stable and have been increasing. That means that the retail participant through mutual fund SIP equity market investment is going at a very steady pace. Concerns, if any, has been on the debt front, as we've seen the episode of Franklin Templeton. And for that also, the Reserve Bank of India stepped forward and said that they have opened up a window through banks. Certain asset management companies who are going through distress can borrow funds. 50,000 crore was the corpus. Again, over there, it will be increased as and when the need arises. So domestic institutions were by and large buyers to face the selling pressure as far as the FIs were concerned. So our sense is that this balance will be maintained because there is enough liquidity with the domestic institutional investors as far as the SIP collection is concerned and lump sum amount into equity market via mutual fund SIP route is concerned or direct is concerned. Well, undoubtedly, we have seen that situation has deteriorated, and we get a lot of calls from our investors as to what they should be doing in terms of investment is concerned, whether into equity market or whether it is with respect to mutual fund, SIPs, lump sum investment, etc., etc. So all those investors, our clients, our supporters, our advice has been that investors should look at companies with earning visibility, good corporate management, strong balance sheet, and management who has got less or no debt or in terms of promoter pledge, leverage money from the market. All these kind of companies will tend to perform much better. At the same time, what we request our investors is, please be very, very careful about buying stocks which have corrected 50, 60, 70% on fallback of corporate mismanagement, on fallback of financial mismanagement, on fallback of huge debt on the balance sheet. In short, friends, what I'm trying to say is that small cap stocks will take much longer time to recover given the present situation. The situation as far as large cap certain sectorial ideas are concerned will do relatively better. And let me just give you one simple example. When the stock market, Sensex and Nifty, corrected maybe 30-40% from those early March till the time we made the lowest low on the Sensex and Nifty, that is 23rd of March, we have corrected almost about 20, 30, 40%. Certain sectorial indices have corrected even much more. But during this time, when markets corrected so sharply, there have been certain stocks which have actually made a new 52-week high or a new lifetime high. One simple example that I can give you is see stocks like Hindustan Unilever or Nestle, as a matter of fact, or even certain lower category FMCG stocks or certain consumer durable related stocks. All these stocks, even if they have corrected less than what the markets or indexes have corrected, or some of them have even performed better and made a new high or a new 52-week high. So we must concentrate on these kind of quality companies. What I always tell our clients is that please buy few shares of good companies rather than buying hundreds and thousands of shares of companies which have corrected on fallback of corporate mismanagement, financial mismanagement, and extra leverage funds on their balance sheet. You should avoid these kind of companies because there is all possibility that after correcting 50-60%, these companies would correct further 20, 30, 40%. So please avoid these kind of companies. Buy quality companies, buy few companies, but buy companies with quality management, strong balance sheet, and of course lesser leverage and possibly excess or cash balances should be there at a very comfortable zone. Remember one thing, you don't have to rush to the market and buy. There will always be tomorrow. Market has given opportunity. Be disciplined. That is very, very important in stock market. And let me tell you, friends, stock market is subject to all kind of risk, especially after 2008. I have deleted a word called impossible in stock market. Everything is possible. And more so after this episode of COVID-19, my commitment has only got reinforced that everything is possible. So please only invest in equity market if you have the capability of high risk. And let me say one more thing. Association of Mutual Fund of India, AMFI, did a study of 4 to 5 different asset classes to find out which asset class gives the best return. They studied bank FD, real estate, gold, and equity market. And after breaking up data of maybe 15-20 years, the final outcome that they came out was the return was best delivered in equity market related instruments, subject to provided investment into equity market is done with due diligence in a disciplined manner and at regular intervals for a longer period of time. And I'm quite sure that India as an economy, because India, as we all know, friends, is a consumption driven economy, it is less dependent on external factors. It is much dependent on internal factors. India, with its population, which has got 35% of young population, large population concentrated on semi-urban and rural India, majority of that population connected with agri activity, and the government taking the appropriate steps as far as agri activity is concerned to boost the production. Because remember one thing, with this situation, there is a possibility of food crisis also. But I'm sure if we have sufficient rain and if the rain gods are kind enough to shower their blessings on us, given the fertile land India is concerned, and the number of population in terms of percentage attached to that agri activity, let us pray to God that we may not have that food crisis if we are able to do things right. So food related crisis is something that I don't expect to see, at least in India. Of course, we have to resolve the issues with respect to supply chain, with respect to the prices that the farmer gets for his or her contribution in terms of production, in terms of whatever vegetables or grains is concerned. So even if there is a slowdown, our sense is that India should get less impacted, subject to, of course, all the terms and conditions that I have put forward remains where they are and they turn favorable. So being a consumption driven economy, we will get affected, but we'll get less impacted by the global slowdown. And as and when the world comes to the terms of the new world order post COVID-19, I think recovery will be visible first over here, and possibly we'll be the first ones to recover. And not to forget, whatever unfortunate events have happened in China, there is a possibility that India could benefit from this eventuality and this epidemic. But for that, the government will have to take right steps, make right policies, attract foreign investments, make them come over here, and that will also take care of unemployment to a great extent. One more aspect that I would like to highlight is that moment we see this stability coming through, I think government will like to start, putting into an overdrive mode the expenditure process, with which it can create employment, and with government spending as far as whatever necessary infrastructure work that needs to be done. If policies and environment become favorable, private capex will also start kicking off, which will also have a positive impact as far as the employment generation is concerned. Of course, this will take time, it will not happen overnight, but policies need to be made absolutely very, very crystal clear as far as those situation is concerned. Overall, friends, my view is that there will be certain sectors that will have its own impact on the positive side and negative side. There will be opportunity in terms of investment into certain sectors. So what I have done is that we have tried to shortlist certain sectors. First, the ones that can have a positive impact of the current situation. Certain companies which will be benefited or have benefited, certain sectors which can get benefited over a period of time because of this situation. I will just highlight certain sectors, and my humble request to all of y'all is that all these sectors are basically sectors which have been shortlisted with an absolute long-term time horizon. With the current situation in mind, I think maybe 1.5, 2 year time horizon if you have, you can look at certain strong companies. Our research team, our team will support you with all those names which has been recommended by our research fundamental team and has an investment horizon of about 1.5 to 2 years. You will tend to win, and try to concentrate on large cap companies first, because that will be the first beneficiary. So the sectors that will benefit in a positive way, first one, of course, specialty in agrochemicals is the sector that will benefit. Second one, though people are buying, though there are few people buying, but people are buying more, our sense is that consumption related sectors will have a less negative impact on the earnings and will be the first ones to recover as the situation gets normalized. So consumption related sectors are FMCG, fast moving consumer goods, consumer durables, and consumer discretionary. These are all consumption related sectors that we remain positive. In the financial side, we are more focused on private sector banks because they have a history of performance compared to public sector banks. And the reason why we would like to avoid public sector banks in the near term is the very recent merger that happened. And even before that, we saw State Bank and associate banks getting merged. We saw Bank of Baroda, Vijaya Bank, and Dena Bank getting merged. After that, we saw 10 banks merging into 3 banks or 4 banks. So our sense is that public sector banks could be the one that could have certain concerns because of this merger activity. Strong NBFCs we would recommend with absolutely great prudent management capabilities. Cement, why cement? Because the government has already kick-started the activity of construction, and this will translate into not only urban and rural India, but even metros will slowly and steadily construction activity start. It remains to be seen, all those migrant workers who have gone back, when are we able to again attract them back to their respective workplaces? Pharmaceuticals, undoubtedly, right from December, January, we've seen pharma sector perform very well. Even till yesterday, pharma sector was moving thanks to the long-awaited wait for that magical drug or an insulin or an injection or an oral drug, whatever be it. So pharma sector will do well. Life insurance related companies also, friends, will do relatively well, because now, given the population of India, the number of insured people is much, much less. And I think what we can do is now insuring the uninsured. That is what the theme is going to be. And my interaction with individuals tell me that with this current episode like COVID-19, people have now become more conscious that they need to go and insure themselves, because if something happens to them, there will be a corpus available to their immediate family members, dependent, in case of certain eventuality. So insurance companies will be the one that will do well. Certain auto companies will do well, which are especially engaged into manufacturing tractors and agri equipments. They will do relatively well. Paint companies, because of lower crude oil prices, large part of the input cost is oil. So paint companies are likely to do well. Certain fundamentally strong infrastructure companies and telecom companies. So these are the sectors, friends, that we feel will do relatively well or will tend to recover faster compared to the other sectors. Now, the sectors which you should possibly stay away or avoid, those sectors are firstly real estate. Second one is, of course, aviation, hospitality like hotel industries, tours and travel related companies, and multiplexes. These are some 4 or 5 sectors. These should be avoided, at least in the immediate time horizon, because these sectors are extremely vulnerable in terms of recovery. They will go through extreme stress in terms of their numbers, performance, and it will take much larger time horizon or financial support for these companies to start delivering on numbers. And let me tell you one thing, especially for the aviation sector, friends, for the aviation companies, it costs more to keep the aircraft on ground rather than to keep the aircraft on air. And aviation companies only make money when their aircrafts are flying more and staying less on the ground. If they stay more on the ground, then the cost is also much higher. So please be a little bit careful as far as these 4-5 sectors are concerned. Lastly, I would like to speak about gold. As my colleague Jyoti was mentioning in her opening remarks, I've been tracking gold for quite some time. And in this new world order, friends, where there is fear of economies going bankrupt. In 2008, friends, we had countries going bankrupt when that companies going bankrupt when the Lehman Brothers crisis happened. After 10 years or 12 years, we are having a situation where countries have started to go bankrupt. Some of them because of geopolitical situation, some of them because of government mismanage, economic mismanage, fiscal mismanagement, etc., etc. So gold will start, and we've seen since the start of 2019, gold has seen a steady rise. And there are reports which suggest that investors should, at least on the lower side, allocate 15 to 20% of their capital to gold related asset classes. Gold related asset classes, which are those? Well, we have gold sovereign bonds, we have gold ETFs, and we have direct investment into physical gold. So what we have been advising our clients is that you can, out of these, possibly you can choose gold sovereign bonds, which are issued by the government of India. Relatively stable, low risk. You get some return over a period of time, and of course, the government backs it in terms of the guarantees concerned. But depending upon your age, depending upon your risk appetite, depending upon your time horizon, please allocate at least 10 to 20% of your total capital to gold related investment. And my logic is that gold is a natural commodity. There has been indiscriminate mining of gold for the past 5 years. This has led to the natural reserves of gold across the world going down at an alarming rate. And if there is going to be operational cost involved, irrespective whether you mine more gold or less gold, good quality gold or bad quality gold, operating cost has always been higher. And in dollar terms, operating cost, I think the gold prices in dollar terms also is likely to go higher over a period of time. Thanks to all these eventualities, my belief is that one should at least invest 10 to 20%. If you have a higher risk appetite, depending upon your age and time horizon, you can allocate more. But I am quite sure that gold will give better returns in a lesser time horizon, given the situation that the new world order has to face. So my humble request is that please be an informed investor, be a smart investor. For all those who are trading, you need to be extremely careful, because over the last 10 to 15 days, or maybe more, we have seen a lot of choppiness in the market. Markets have opened gap down and have closed by substantial gains some days. Some days, markets have opened gap up. By the time we wind up the trade at 3:30, all those gains are wiped out and we correct with sizable amount of correction. So short-term, medium-term traders, you need to digest extreme volatility. Gap up, gap down, intraday volatility will be very high. Volatility will be high for at least in the short to medium term. So please be careful if you're trading. And if you're an investor, I think any level closer to 9,000 or below 9,000 will be a great opportunity to buy. Be a disciplined investor, be an informed investor, and invest for a long-term period. Don't be in a hurry to make money into the stock market. And let me again reiterate what I said. Stock market is exposed to all kind of risk. There is no guaranteed return. There is no sure shot return. There is no guarantee of capital also. So please bear all these things in mind. But if you have to look at history and data and performance, then equity market related investment, if done wise enough, if done with certain understanding and knowledge, has always delivered great return. With this, I would like to conclude my talk. I hope I have been able to resolve most of your queries. I also would want to wish all of you all and request all of y'all, please stay at home, stay safe, and stay strong. Now, I would request my colleague Jyoti to take up with Q&A session. I'm sure you all have sent quite a few question and answers. I will possibly try to answer most of them as much as I can. Thank you all. Jyoti, over to you for Q&A.
Thank you, Mr. Shah. Before we start the Q&A session, I would like to inform you all that we have received an overwhelming number of questions. And I think Mr. Shah has tried to answer most of your concerns in his talk. For the remaining questions, let's go ahead with the Q&A session. The first question, what are the value buy options for long-term investment? Which are the best stocks to invest in the Indian pharma sector?
I am quite sure that there will be a lot of questions as far as. So I have already made out a list of, for the benefit of all our clients, I made out a list. But since this is a specific query with respect to certain sectors and stock, and Jyoti, you will have to help me because I may forget some of the sectors that you mentioned. So I will recollect, if I recollect right. First of all, there are no sectors which will be absolutely away from correction. All sectors are vulnerable. No single sector will be escaping as far as the correction in the market is concerned. But to answer your question, pharma sector, well, let me say this. First of all, pharma sector has gone up to a certain extent over the last couple of months and weeks. So if you want to invest afresh, invest gradually in very well established pharmaceutical companies. So what are those companies? Well, Ipca Laboratories, Biocon, Zydus Wellness, Alembic Pharmaceuticals. Then we have Dr. Reddy's, we have Cipla, we have Biocon. These are some of the names on which on the fundamental side also we have a positive coverage. So we can possibly look at all these companies with respect to the long-term investment is concerned. Which was the other one, Jyoti, in terms of sectorial question?
Well, they would like to know which are the value buy options for long-term investment.
So value buy options in long-term investment. Well, then I think I'll have to break up all these into different sectors. So in specialty chemicals, we like PI Industries, Aarti Industries. We also like UPL, Pidilite. These are some of the specialty agrochemical companies that we are positive on. Pure fertilizer related companies, we are positive on Coromandel International. From the banking side, we like HDFC Bank, Axis Bank, ICICI Bank, and Kotak Bank. From the NBFC strong that I mentioned, then HDFC Limited, Cholamandalam Investment, Shriram Transport Finance, M&M Financial. These are some of the companies from the NBFCs. From the FMCG category, we are positive on HUL, Dabur, Marico, Godrej Consumer Products Limited. From the paint industry, we are positive on Asian Paints, Berger Paints, Kansai Narolec. Certain asset management companies like HDFC, AMC, we are positive. Then amongst the new listing, we are positive on IRCTC. There was a report IPO note for long-term investment. SBI card also comes under our IPO coverage for long-term investors. So these are some of the sectorial investment ideas. On the cement front, well, all the three large cement companies, ACC, Ultratech, Ambuja, Dalmia Bharat, Shree Cement, Ramco Cement, amongst the cement companies that we are positive. And in the life insurance sector that I mentioned, all the three life insurance companies, that is HDFC Life, SBI Life, and ICICI Prudential Life. So I hope I'm able to give a sizable amount of stock-specific answers. Jyoti?
Well, moving on to the second question. The investor wants to know, should I continue to hold L&T Finance Holdings at an average rate of rupees 153? Is it the right time to invest in granules?
Well, so L&T Finance and Holding also happens to be one of the companies that we are extremely positive as far as our long-term investment idea is concerned. But this investor needs to average, because I think the cost as of now, as we speak, as of yesterday, was somewhere close to about 50 or 60 odd rupees for L&T Finance and Holding. So if this investor has investable amount, I would possibly advise maybe 40-50% averaging at current level, so that your cost of investment comes down. On granules, Jyoti, unfortunately, there was this regulation in 2014 by SEBI. I am not sure whether we have a coverage, and we are not supposed to comment on companies on which we don't have coverage. So on granules, I would give it a pass, since I'm not clear whether we have a coverage or not. We can take the next one.
Okay, moving on to the next one. In the present situation, is investing in RBI bonds and gold bonds better than debt instruments?
So again, it depends upon an individual's risk appetite, Jyoti. If you are totally risk averse, and let me say this, when you invest in gold, don't compare gold investment like you treat your equity market investment, because it's a totally different investment asset class. And if you look at the history of gold as far as return is concerned, then gold gives you return once in 3 years, 5 years, or maybe more, depending upon situation and circumstances. But given the current situation and circumstances, I'm sure gold will give you return at a much faster rate. So, like I mentioned in my concluding remarks about the market outlook, and when I was speaking on gold, at least 10-15% make sure that you invest in gold related asset classes and products. And as far as your debt market related investment concerned, well, to be very honest, I'm not too qualified to comment on debt market related instruments. So I would advise this investor to possibly take this question up with one of our financial advisors who possibly has an in-depth knowledge about this debt market products. Jyoti?
Well, the next investor wants to say, as you know, HUL has touched a high of rupees 2,614. Will we see such levels in the future, and what are the prospects for the company in the next 1 or 2 years after GSK sold its stake? He also wants to know your views on HDFC Bank, Pfizer and L&T.
So HDFC, Pfizer and L&T. Pfizer, again, one of the companies which I don't recollect we have coverage, but I have looked at the balance sheet, very strong company. Volumes are very, very low as far as Pfizer is concerned. So you need to be careful if you are a short to medium term trader. But if you are an investor, I think you possibly understand the company. I have understood it. The company is very strong as far as balance sheet, products, management is concerned. Absolutely no doubt. HUL, well, I just referred to HUL in my remarks when I was mentioning about the market correction. And HUL was one of the stock which corrected relatively lower. And in fact, when the market was correcting, HUL did relatively much better. So my advice is that HUL will tend to do well. It is only that, when certain stocks outperform the market, there comes a time when it kind of consolidates. But given the history, given the volumes, given the margin front, given the product profile, given the acceptability of products amongst the consumers and product recall and the self-life visibility, I'm quite sure HUL will do wonders if you are a long-term investor. So stay invested, and maybe you can invest as much as possible in HUL. But again, don't allocate large part of your capital to one particular sector or one particular stock, because that is also not advisable as far as fundamental is concerned. Don't over leverage yourself to any sector or stock. Jyoti?
Well, the next investor wants to know what will be the future of public sector banks in India. Is it worth holding these PSU banks? What are the chances of recovery?
So public sector banks, like I said, we have mergers going through very recently. In the past also, we saw State Bank of India and associate banks getting merged. Bank of Baroda got merged with Vijaya Bank and Dena Bank. And then we had 10 banks merging into 3 or 4 banks. This merger leads to stress on the balance sheet because what happens is that banks get merged into relatively mid-sized, stronger or stronger public sector banks. And this leads to a lot of concern on the balance sheet as far as quarter-on-quarter numbers are concerned. So the only bank that we are positive on and on which we have a positive coverage is State Bank of India and I think Bank of Baroda. Other public sector banks, I will not comment because we don't have a coverage, and according to regulation, I can't comment on banks or companies which we don't have a coverage. So only two banks, State Bank of India and Bank of Baroda, but that also with the caveat that it may take longer for recovery. And if you are not invested and if you're looking at investment, then private sector banks, like I mentioned, HDFC Bank, Axis Bank, ICICI Bank, Kotak Mahindra Bank should be the preferred investment ideas. Jyoti?
The next question is from a retired person. He says that he's focusing on investing in quality stocks for the long term, and he has invested in L&T, HUL, Britannia, Godrej, HDFC Bank, HDFC AMC, TCS, Pfizer, AstraZeneca, etc., and a few PSU stocks for dividend investment. He wants to know whether his approach to investing is correct. This is from a retired person.
I'm sorry, Jyoti, you'll have to repeat that list. I missed out a couple of names. I couldn't hear you properly.
L&T, HUL, Britannia, Godrej Consumer, HDFC Bank, HDFC AMC, TCS, Pfizer, AstraZeneca Pharma, etc., and a few PSU stocks for dividend investment.
So, like I mentioned, Pfizer and AstraZeneca, I mean, both of them are, companies which have a historical proven track record. Their management is beyond doubt, great credibility in terms of corporate management. Unfortunately, since we don't have a coverage, I cannot directly answer the question, but the other names that this gentleman has got invested in, I think he's picked up the best of the names in different sectors. For the public sector companies, well, since the names are not out, let me say this. There is a history of underperformance as far as public sector companies are concerned. And as like I mentioned in my outlook about the market, as and when the situation starts getting normal or stable, as and when the markets also start recovering, government would want to accelerate the divestment process. Unfortunately, there was a speed breaker in form of this lockdown and COVID-19, which has resulted into some kind of delay. And companies have not really done well as far as performance is concerned for public sector banks. So my sense is that if you are breaking even, or if you are in a little bit of profit, try to reduce your exposure on public sector companies, because it'll take very long period for these companies to perform. Though we are positive on certain public sector companies like all the three oil marketing companies, ONGC, GAIL, BEL, etc. But risk reward wise, return on investment wise, you are better off with certain fundamentally strong private sector companies. So the other names are good enough, but public sector companies, depending upon which company this gentleman has invested, he should review his position. Jyoti?
Yes, sir. The next question is from an investor who says, I'm holding ITC, ICICI, SBI, and SBI cards. Should I hold them for the long term or exit for small profits?
Now, this is a classic, question. So you have to first decide what is your time horizon. If you have invested from a short to medium term, you have to take a call and you have to decide accordingly, according to your risk appetite. But from a long-term time horizon, ITC, HUL, SBI, SBI cards, and like I mentioned, SBI card, we have a long-term IPO note, and we had advised our subscribers to invest in it. So if you're in for a long term, you can stay invested and you can average also, in case if the prices are much below your investment level. And if you're a short to medium term investor, you have to decide according to your risk appetite and your capability and capacity. But if it is for long term, like I mentioned, we are positive on all the names that he's mentioned. Jyoti?
For the next question, I'm actually combining the questions of a few investors. It's all related to gold. They want to know what is your opinion on investing in gold, whether it's good to buy gold derivatives like ETF in the present condition, and whether it's better to buy gold or stay invested in equities right now.
So again, it is always better to have a diversified portfolio in different asset classes. And like I mentioned at the end, when I was giving our outlook on gold and the reasoning that gold is and will always remain a global currency. It will depend upon situation and circumstances globally, whether it is a geopolitical situation or whether it is on fallback of certain epidemic like this one, COVID-19, or whether it is because of certain mismanagement of government as far as their fiscal prudence is concerned. So depending upon your, like I mentioned, depending upon your age, depending upon your risk appetite, depending upon your time horizon, at least allocate 10 to 15% to gold related asset classes. Now, we are also positive on gold, and we are in fact advising gold bonds, sovereign bonds as an investment idea. You can choose gold ETF also, and you can choose physical gold also. The only problem, Jyoti, is physical gold, you have an issue of storage. You can't keep large physical gold at home, nor can you keep it in your bank locker. And normally what happens is you end up having sleepless night in case if you have large quantity of physical gold. So gold bonds, sovereign bonds is the preferred choice. Gold ETF is the second choice, or third one, gold ETF. But allocate at least 10 to 20% and have different diversified portfolio. Put some in gold, put some in equity, put some in mutual funds, life insurance, etc., and have a diversified portfolio rather than having concentrated onto one asset class. Jyoti?
We have a few questions on specific stocks. One is Ashok Leyland, the other is Bajaj Finance, and you've already addressed HUL. They want to know what are the prospects and whether they should stay invested in these companies.
So HUL, and which was the other one, Jyoti? Sorry.
Ashok Leyland and Bajaj Finance.
So we have a buy coverage on all the three: HUL, Ashok Leyland, and sorry, which was the third one, Jyoti? You'll have to repeat.
Ashok Leyland, Bajaj Finance, and HUL.
So like I mentioned, HUL is one of the star performer. Ashok Leyland also, we believe that as and when, and like the Honorable Union Minister, Mr. Nitin Gadkari, who was addressing and giving up a press conference, there is going to be a scrappage policy out very soon. And if that happens, then the number of vehicles that need to be replaced as far as commercial vehicle and buses are concerned is humongous. So that will lead to a huge replacement demand. But we are awaiting the scrappage policy. I hope it comes out sooner rather than later. But from a long-term perspective, we are positive on all three. You can stay invested and you can average also in case if the prices are much lower than your initial investment level. Jyoti?
The next question is, can we invest now in medium and small cap stocks, expecting it to recover once the current situation settles down?
So small cap, like I mentioned, avoid small cap because my sense is that the recovery will take much longer. And in these kind of times when there is going to be earnings distress, not only for the small cap company, but also for certain mid cap and large cap company, I don't think you are going to see any magical revival for small caps. It'll take very long. But again, you need to be stock specific. And we have very few small cap stocks under our fundamental coverage. But my advice to this investor is that look at large cap, look at certain mid cap companies in IT, in private sector banks, in FMCG, in cement, in pharma, in NBFCs, in paint sector. I think these are the sectors which we believe mid cap will also do relatively better. And if I have to just again give one example, look at IT, NIT Technologies. It came out with numbers, I think just 2 or 3 days back, and the numbers were so good that the stock was up almost about, I think, 10-15% or more. So you need to be careful when you are buying certain mid-cap stocks. You need to concentrate on sectors and look at the financial of the companies also. It is not very difficult. And if you need any help, then I think our team, our branches, our team all over India are always there to help our clients out. Jyoti?
Well, moving on to the last question. This is one on mutual fund. Many of our callers today have had doubts on mutual funds. What they want to know is whether they should still continue investing in mutual funds, as the returns from most of them are showing negative. And they also want to know your views on whether they should continue investing in debt funds post the Franklin Templeton issue.
So, like I mentioned, debt fund, I'm not too clear about debt fund, so I will restrict my comments over there. But I hope there'll be some sanity and clarity as far as debt funds are concerned. As far as investment into mutual fund, equity related mutual fund SIPs or lump sum investment is concerned, like first of all, let us be very clear. Mutual fund investment is always long term, and by long term definition is in mutual fund 3 years, 5 years, more the better. When markets correct 30-40%, it is but evident or accepted that mutual fund will also correct accordingly or more, depending upon which scheme you have bought, whether you have invested in large cap, whether you have got invested in mid cap, whether you got invested in multi cap, or whether you got invested in small cap, or whether you invested in sectorial thematic funds. So it all depends upon that. In times like this, you should not only continue with your SIP, but you should also make an effort to see if you can, that you can allocate more towards your SIP investment or your lump sum investment into equity market. But make sure, depending upon, like I said, scheme to scheme. Now, if you ask me, I will give a disclosure over here. Since we are a compliance oriented company, we have a lot of compliance related issues to deal with. And I personally do not invest directly into equity market because of compliance issue, reporting, etc., etc. My personal investment, let me give it a blanket disclosure, is via mutual fund SIP. There are at least 3 or 4 SIPs getting debited even today in current scenario from my savings bank account. And not only have I continued with my earlier amounts, but I have also allocated more and newer SIPs I have made. Again, a disclosure, my SIPs are restricted to large cap and select mid cap, that is select mid cap and large cap, multi cap fund. I do not have any exposure to small cap or any thematic fund. So this is my principle of investment, and I always appreciate, and I always see it as an opportunity to invest more into equity market via SIP whenever markets correct like this, because eventually, remember, markets are not going to stay here. History is witness, markets will recover and situations will improve, and I'm quite sure that all of us will be disciplined and we will overcome the current situation also. Jyoti?
Well, thank you, Mr. Shah. With that, we come to the end of our Q&A session. Thank you all for joining us. We look forward to the feedback from all of you. If you have liked this session, if you would like us to have further sessions like this. So until we meet next time, thank you very much. Stay home, stay safe, and stay healthy.